Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime Edition. On Monday's Stock Play of the Day, we talked about Clorox. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest. On Monday's Stock Play of the Day, we were a little bit bearish on Clorox. And as you see here on my chart, we actually have a 5-day chart. It's a 15-minute chart. So I'm going to highlight here on Monday where the underlying stock was at. It was trading right around 200, and that would be on Monday, January 4th. So this line actually represents where that stock was at when we talked about being a little bit bearish on Clorox. Now, overall, the company has been really strong. Part of the reason why we were going to be a little bit bearish is that the growth since the pandemic of the company and the earnings and all the positiveness in the company needed to just wane a little bit. So we were looking for a little bit of a downturn in the short term on Clorox. And as you can see from the chart here, there were only a couple of times since Monday where the stock was actually above 200. All day long, it hung out around 200. It opened a little bit up, traded down most of the day, once again opened up, and then we eventually broke to the downside. Our target on the downside was right around 193. We're going to highlight that on the next chart that we're going to look at. But right now it's trading at 195.18. That's where the last trade was at. Our short strike of our trade was right at 195. So that was a range that we were targeting overall. If we actually look at the big chart, or the 3 month, I guess this was a 6-month chart on Clorox, we just kind of highlighted this little area to the downside that was going to provide a little bit of support if the underlying stock did come down to a certain range. And I'm going to highlight here on the chart, there's a couple points where it touched, so it was a fairly good trend line overall. We came very close to that trend line just the other day, came all the way down. It didn't stay there very long, but we did actually come very close to hitting that trend line, right at 193. And that would be an area where you'd think about taking the position off. You would obviously be profitable on that trade. But we did mention that if we do this long put spread, we want to be right on our forecast a little closer to the expiration date. So let's talk about the long put spread overall. What we did was buy an option contract, buy a put that went out to the January 22nd expiration date. So right now we have about 14 days remaining. We did this on Monday. So we had about 18 days, or no, it'd be about 19 days when we put the trade on. We bought a little bit in the money option contract in the options playbook that would be referenced by strike B. And then we sold a little bit out of the money option contract. Now, the big thing was we sold the 195 strike. We're targeting the 193 area, but we sold the 195. And that's more common. If I'm looking at a long put spread and I'm going to sell an option contract, kind of targeting a specific point, I usually want to sell something on the put side that's just a little bit above where I actually think the underlying stock was going to go to. So in this instance, we sold the 195. We mentioned that we're just going to go out a couple of weeks in time, because when you sell this option contract, which would be strike A, that's battling against your strike B. And ideally, for this thing to max out, you need some time decay on that option contract that you sold. So if I sell a put, I want the market to either stay where it's at or I want the market to go up. When I buy a put, I want the market to go down. So they kind of conflict with each other. But the reason why we did this is that markets have been volatile. So there's a lot of premium in the option contracts. And we're talking about a $200 stock that also adds some premium to the option contract. The more expensive the underlying, the more expensive the option contracts will be. That's just a matter of fact in the option trading world. So let's look at the actual trade. If I go into the Ally Invest option chains, We see here that Clorox is down today. It's not down to the lowest point since Monday, but it's trading fairly close. It's at 195.12, down $1.31, or about 0.75%. The January 22nd expiration is the one that we were looking at. There's currently 14 days remaining. On the left-hand side of our option chains, we have the call chains. On the right-hand side, we have the puts. I already preloaded the trade that we talked about on Monday. So what we bought was the 2250 strike, and we sold the 195 strike. I'll scroll down, we'll look at it inside our options workbench. On Monday, when I first looked at the trade, it was trading below $3. But at the time of the stock play of the day, which is taped every Monday at noon Eastern time, it's a live show. It was trading at $3.25. So what did that mean? We did a 7.5 point wide spread, and we paid $3.25 for it. Our max risk on that trade then would be $325 plus commission. That's for every 1-by-1 spread that we did. Since it's 7.5 points wide, you take 7.5 minus 325, and our max upside would have been $4.25, or $425 less commissions to put on the trade. Now, I always have to emphasize on the stock play of the day, where this is not meant to be a recommendation. We're just trying to learn here about option strategies in general and what might fit the specific market conditions to try to take advantage of our forecast. All right, so the stock's gone with us. If I had this position on right now, what I would look to do is have a sell order to get out of the trade at a price that I would like to get out of the trade at. And that would be a good till canceled order. So on the overtime edition here, we're going to enter that order just like you normally would inside the Ally Invest option trading platform. So from the workbench, I just click trade, and then we got to do the opposite of everything that we just did. So if we're sold that first option, the 195 strike to open, we need to buy to close. And then if we bought to open the 202.50 strike, we then need to sell to close. And if we look at that, we can get that done for a net credit of $5 to the account. That's fine. I might have gotten out of this trade when it went down to 193, where it didn't stay there long yesterday, but mainly because that was the area that we were targeting. We thought it might bounce off of that range. And so if it got down to that level, I probably would have got out of the trade yesterday. But you could obviously get out of the trade right now if you'd like. It's actually up a little bit more. Now it's trading for a $5.10 credit. If I were to put a good till canceled order in, here's where I would go. I would like to keep this trade live, and I would go $6, approximately that. The maximum it can trade for is the width of the spread, which is $7.50. Let's say $1. Let's go $1 away. Let's go $6.50 on the trade. And I'll just keep that order in. Now, I'm going to be watching the chart. If it gets down to 193 again, I'd probably just get out of it. But I'm going to make that a good till canceled order. And this is the order that I would keep live to close this position. Getting that last dollar out of a fairly expensive underlying like Clorox, a $200 underlying long spread, is kind of hard to do. So we're going to target most of the gain, but not all of it. The maximum potential that we could receive would be that $7.50. Now, the way I'd read this back to you is that I'm going to buy to close the January 22nd expiration, 195 strike put, and at the same time sell to close the January 22nd expiration, 202.50 put. We're going to do this for a net credit of $6.50 to the account, less commissions, and the duration is going to be good until canceled, until I go out and cancel it, or until 60 days has passed and the system will automatically auto cancel it. But by that time, the expiration would have happened, so we'd be out of that trade. So simple trade, mainly because the market has gone with our forecast. So that's usually quite easy to do our overtime when that happens. I'm just going to highlight down here the actual profit and loss graph inside the Ally Invest platform. This would be if the trade was done today. When we did the trade, it was trading right up around 200. We see it now down by our middle strike at 195. we see on the colored line, there's still a bunch of time premium. And that all comes from the fact that we sold that 195 call and or put, I'm sorry, and we still have time remaining in it. So as the days, I'm going to move the days to expiration down to 1, and I'm going to regraph it. And you will see now that colored line starts morphing into the expiration graph. So ideally, we would have hit the 195 level a week from, or I should, the 193, which is really our target, a week from now, but it happened already. Trade is profitable. Think about getting out, put in your good till canceled order. Also, manage your risk because it could also come flying back, right? And on this trade, the risk was $325. Maybe you say to yourself, well, if it does come back and it goes back above 200, I might just close this trade out and salvage what I can on the trade. So there's 2 different ways to look at it. We talked about managing the risk on the Monday stock play of the day. And that's all I have today. It's a simple trade because why? The market went the direction that we wanted it to. So that's going to be it for this edition of the Stock Play of the Day Overtime. Please click subscribe and ring the bell, and we'll see you this Monday on the Stock Play of the Day at noon Eastern Time. Thanks for coming, everyone.